market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Anna Edwards in for Francine Lacqua this morning in London. Now, the Fed chair has been dashing hopes of an early rate cut in response to President Trump's tariffs, signalling a wait-and-see approach on the impact.
Tariffs are highly likely to generate at least a temporary rise in inflation. The inflationary effects could also be more persistent. Avoiding that outcome will depend on the size of the effects, on how long it takes for them to pass through fully to prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored.
Joining us now, our Markets Live executive editor, Mark Cudmore, with thoughts on the markets right now. Mark, so it seems widespread, the interpretation in markets was that this was a bit more hawkish. There was more emphasis perhaps on inflation, and we saw risk assets reacting accordingly to that. But under the hood, what did you take away about the reaction function of the Fed? Should we see a real slowing down of the U.S. economy?
Good morning, Anna. I think the key point is that Powell is not close to delivering a Fed put, and that was why the overall interpretation was slightly hawkish. It wasn't so much that he is committing to, clearly not committing to rate hikes, nor that he was pushing back on the idea of rate cuts overall. He's more just saying, hey, first we've got to make sure we don't have a major inflation problem, and hey, yes, we're worried about the growth outlook, but the hard data hasn't turned down yet. It's the soft sentiment indicators. If we see that data turn down without an inflation shock, well, then we maybe have to react. So I think it wasn't kind of giving the doves what they wanted as opposed to explicitly hawkish. It was basically the idea that, hey, we think the growth outlook is worrying. We think there are problems on the horizon, but we're not going to be rushing to the market savior just yet.
And what do you make of the trade talks that we've seen so far? A lot of emphasis this week on the talks between Japan and the United States. One of the details that stood out to me was that there were 75 minutes of conversation between the two teams. And for 50 minutes, President Trump himself was in the room, which I thought was quite an interesting takeaway. For markets, what are you watching for?
I'm expecting they'll still get some more positive sound bites out of the US-Japan talks overall. I think, remember, there's a 90-day window here for negotiations until these kind of reciprocal tariffs are meant to be reimposed. And I think that generally we'll get some positive sound bites. And I think that'll give the market encouragement that, hey, maybe deals can be negotiated. My worry is that at some point that we're playing a kind of game plan where, if the concrete deals aren't brilliant, and if the removal of tariffs isn't as absolute as some people are hoping for, then we're going back into that negative story. And I think one of the really interesting dynamics we've got at the moment is that tariffs overall are much higher level than many people were considering only about 2 months ago. And they are going to be very damaging for the US economy and for the global economy. And they're going to be more inflationary. So we've got a massive stagflationary impulse that we didn't have a couple of months ago. And that's really genuine. We just don't know how strong it's going to be. And that means that I think we have to take a step back and not try to trade the theme too aggressively. Just because it might not be as strong as we thought maybe a week ago, it's still way stronger than 2 months ago, which means that overall, this is going to be a tough year for markets. Overall, US exceptionalism is over. Overall, the dollar is going to continue to depreciate, and I expect more bouts of Treasury weakness ahead, but we don't have to trade those themes too aggressively. We can wait to the next iteration of the story, and in the interim, we can get some relief flarities.
Yeah, OK. Mark, thank you very much. Our Markets Live executive editor, Mark Cudmore, with thoughts on where trade negotiations meet markets. Let's take a step back and think about where we've got to on those trade negotiations then. President Donald Trump says negotiators made, quote, big progress in a meeting with Japanese officials seeking a deal to avoid higher levies. Joining us now, Brendan Murray, who, of course, runs our global trade coverage here at Bloomberg. And Brendan, that detail for me that stood out was that President Trump was in the room for so much of it. What stood out for you when it comes to the Japanese conversation as we know it so far?
Well, first of all, it was a surprise to all of us when the president posted on social media yesterday that he was going to participate in these talks. You can imagine the Japanese delegation scrambling to adjust to the fact that the president himself was going to be in the room. But I think that there are a lot of optics here to follow up on what Mark was saying, that the president Japan being the first mover on these talks, the president wants to show other countries that, look, we're rolling out the red carpet for you. If you want to do a deal, we're open to talks, and that will kind of open the door to South Korea next week, India in a couple weeks after that, and who knows, who could come after that. So I think this was about setting the tone, and the tone being we have 90 days to hash something out. What exactly that could be, we don't really know. The real game here is about China and reducing the trade imbalance with China. Remember, Donald Trump's ideology of protectionism dates back to the 1980s when Japan was the big threat from Asia. So now that the context has totally changed.
Yes, and it is, when we're seeing these conversations play out, it's interesting to think about what is happening in parallel, what happens in sequence, how much do you get all of these conversations happening and delivering perhaps around the same time, which would make your life very busy, Brendan. Let me ask you about the US-China relationship then. We heard from the Chinese yesterday that they said they'd be open to talks, but the US needs to show respect. What progress have we made in getting people around a table? Because I'm not sure that's even happening yet.
Well, the optics from the Chinese side are interesting this week as well. We had President Xi traveling to Cambodia, to Malaysia, to Vietnam, talking about an Asian family that needs to stick together. So you have basically these two counterparts in this global trade war trying to line up their alliances and to make sure that that there aren't that the trade in the region stays strong. So you have this interesting counterplay between what President Xi is doing and what President Trump is doing, both different tactics, but trying to achieve the same goal. Yes,
both seeming to be going after China's neighbours. So China trying to bring them on board as this family, as you describe, and the US trying to isolate China from its neighbours perhaps a little bit and its other prior allies. Brendan, thank you very much. Brendan Murray, Bloomberg's Global Trade Czar, joining us with the latest on the trade story. Let's get a check on some of the biggest movers in the market. We've had some earnings to deal with as well. Joe Easton has a briefing. Joe.
So Siemens Energy really the standout performer today, and we're up around 11%. The company reporting strength in its margins in the grid business, also the wind turbines. Now, this stock had a really poor run over the past couple of years after its spin-off from Siemens, but actually more than trebled in value, so investors getting a good return on Siemens Energy at the moment. Then in terms of luxury, kind of chalk and cheese in terms of the stocks that we've got out today. We've got Hermes, those £80,000 Hermes Birkin handbags not doing as much business as they were expected to, but only missing very slightly. So that stock coming down around 2% on the quarterly numbers. Moncler as well, that was weak. Your Stone Island jackets, favourites among football fans. That one looking a little bit soft as well. And Brunello Cucinelli in the cashmere sweaters, 900 quid they'll cost you for a cashmere sweater, but that one actually not looking too bad, but not the best day for luxury. Hermes still the most valuable luxury goods company in Europe. Then we've got Pernod Ricard. That was soft. The company missing on their sales once again, a big drop down in sales and facing some regulatory scrutiny over in China with some anti-dumping probes on brandy as well hitting that company. Then we've got Sainsbury's, the firm, of course, gearing up for a busy Easter with all those Easter eggs. I've been down there to get mine already, thankfully. Now, Sainsbury's actually missed on the profit. The profit was weaker than expected. They're pretty much going to have no profit for the year ahead, but this was already priced in following a profit warning from Tesco and also from Asda as well. So actually priced into the market and investors actually buying back into that one today. Then finally, just to finish on a bit of deal news, ABB spinning off its robotics business. This is an almost $100 billion market cap for ABB in this company, about 7% of the business in terms of the spin out, the robotics unit. So that is being taken positively today. ABB rising 1.3% on that positive spin-off news this morning. OK,
Joe, thank you very much. Joe Easton from our equity team with a briefing on some of those stocks that are moving. Joining us now to talk about where we go on equity markets, Nataliia Lipikhina, who's head of EMEA equity strategy at JP Morgan Private Bank. Nataliia, thank you for being with us this morning. So let's talk about investor strategy and flows from the United States to Europe. It seems to be a big theme we talk about with lots of investors at the moment. What are you seeing in terms of the European investor base and their desire to bring money home?
Good morning. Very nice to see you. We're definitely seeing that investors over the last decade built a very big overweight to the US markets and to the US dollar. And now this has been into the question, especially given the FX moves that we've seen in the last couple of weeks. So we do see the appetite of closing potentially some of the underweights to the European market in the last couple of weeks. And we continue to say that we're global investors. We do like being in global equities, and that includes having exposure not just to the US market, but also international, including Europe.
OK, so global investors, so exposure to Europe. And then let's dive into the European earnings story then, because what are the interesting things you're taking away from the earnings season so far? It's interesting to see how different companies are navigating the huge uncertainties that lay ahead for 2025.
Absolutely. So the market is expecting 3% earnings drop this quarter. But I think what will matter more is guidance, or the lack of guidance. And I think the market will be looking into the comments as to how the companies, as you rightly said, will navigate that. And I think as long as the companies have a particular strategy of how to navigate these tariffs, I think the market will reward them. And I think specifically for Europe, the domestically oriented companies are probably slightly better positioned this time around compared to exporters, which are more exposed to tariffs and FX risk.
So which kind of sectors within which markets does that take you into? If you're looking for the really domestically exposed businesses, so not the big exporters, as you described, where does that take you?
I would say some of the industrials companies look quite interesting given the domestic story in Germany with the German fiscal stimulus. We do like some of the financials names here as well, including banks and tech. Even though tech is an international sector, we still think that there are values in that sector.
Do you have any sort of pointers for CFOs and CEOs as they're putting together their earnings releases, thinking about the guidance they're going to issue to markets, about how to pitch it to markets? Because some of them seem to be saying we're sticking to our guidance, but there are these huge uncertainties. And so we're not changing our guidance because we just simply don't know what to change it to. But that's not necessarily a really positive story, is it? It just means there's a huge amount of uncertainty ahead. So how would you suggest that businesses should sort of sell this message to investors?
I think if we have some sort of a scenario analysis, that will help the investor community try to price and try to forecast as to what may happen in the future. Because we don't know how tariffs will actually pan out from here. But if we get a bit of a guidance that this is where, our sales forecast or operating profit can go, that will help. And this is how we're thinking about on the strategy team side, thinking that probably the range of outcomes this year is a bit wider than usual just because of the tariff uncertainty. And we think that this uncertainty will probably close as we go through the year. But for now, even looking into earnings, we may see that earnings may even flip into negative territory this year, but they may be, close to high single digit this year. So the range of uncertainty is just very high.
OK, so a range of scenarios maybe is a good way to present that level of uncertainty. I noticed in your notes that you think technology companies look particularly attractive after the recent sell-off. Where are you looking for those? Where do you think that they've been oversold in the recent period?
We particularly like software companies because we think the semiconductors are still a bit exposed to the tariff and trade uncertainty. But software looks very interesting, especially if we think that AI trade still has legs. We're going to hear from big tech companies, and we hope that they will all confirm their capex guidance for this year. And therefore, we think software is the right place right now.
Yeah. Have you heard anything from the likes of ASML, Nvidia, TSMC that makes you think maybe we don't get that positivity from the big tech companies a little further up the supply chain, perhaps? But are you concerned that maybe big tech is not going to be spending quite so much in terms of building out data centers and the like?
Not really, because what we heard so far is actually the confirmation of this AI trade. And we heard from a couple of companies in the US confirming the capex guidance this year. So we feel quite comfortable going into the earnings season.
And here in Europe, do you expect the ECB to shore up, maybe not with this intention, but to shore up markets with rate cuts? I mean, we're expecting one rate cut today. Possibly we'll get some more from the ECB. What is your expectation for the central bank?
Yeah, I think the 25 bips cuts is priced in by the market for today. We think that another, 50 probably can come into the market, but will be really, really important today is the outlook on the economy as to what is happening, if tariffs are actually impacting the market or not, and where the economy can go from here. Because in our analysis, we think that the European growth may be a bit weak this year because of the tariff uncertainty. So hearing that from central banks can be quite reassuring for the investor community.
So do you think, I mean, I guess without knowing exactly the extent of tariffs, it's difficult to answer, but can the German spending on defence and infrastructure, can that outweigh the negatives around tariffs for Europe?
We think so, and I think this is what investors are also focusing on. And there is a bit of a lag between the timeline, because if we're thinking about the German stimulus, this is more for 2026 story, but it gives a bit of a longevity for the European market. OK,
thank you very much. Thanks, Nataliia. And Nataliia Lipikhina, head of EMEA Equity Strategy at JP Morgan Private Bank. Coming up on the programme, we'll get the latest on the luxury sector. Hermes shares fall as weak Chinese demand hurts its sales. We get a deep dive on those results and the darkening outlook for that luxury sector. That's next. This is Bloomberg. For the conversations that matter and the insights you need, this is The Pulse. I'm Anna Edwards, in for Francine Lacqua in London this morning. Now, Hermes sales at the start of the year were hurt by a slowdown in Chinese demand, showing that even the most resilient purveyor of really high-end goods hasn't been spared from the slump. For more, Deborah Aitken from Bloomberg Intelligence joins us. Talk us through what we've heard from Hermes then. The full-year consensus stays intact from this business. But what's the detail we need to take away from the Hermes numbers then this morning, Deborah?
Hi. So we saw Asia ex-Japan being the one area where, 4% growth. And the market really, when we're looking on an organic basis, we were really kind of trying to expect them to be up around mid-single digit. They're saying that actually China in particular, the numbers there are flat. Elsewhere, we have double-digit growth across all regions and key markets. So that's a positive. But overall, because of China, we saw Q1 organic sales come in at 7.2%, which was about 70 bips below expectation in the market on consensus. And I would say that's already actually being clipped this week because of LVMH and that -5% on their organic growth, which also from us was linked mostly to China. And then when we think about the full year, actually for the full year, the company has said high single-digit growth. And consensus is still slightly ahead of that at around 11%. And I'm looking further down at the operating margin of 40.5%, which is aligned to 2024. And that probably needs to be brought down too.
OK, so some concern around consensus there. Talk us through the weakness in China. What's happened and has sentiment really changed there? We've been talking about another luxury good, a very different one, but Pernod Ricard this morning. There's a different issue there. That's about tariffs on cognac into China. But Hermes also weak in China. So what's the story?
Yeah, I think, not to overplay it, but actually they're up against a very big comp, a big New Year recovery last year. But when we look overall, we can see that there's just less footfall, and they're saying actually into April, it's got a little bit softer, so less store traffic. But the big categories are doing well. The high price categories are doing well. So it's silks and some of the accessory side, the lighter price points that are maybe feeling a little bit more of the pressure. And we'd expect that to continue through the second quarter.
Yeah, and thinking about price, Hermes has been talking about price and how they're going to prepare for tariffs or tackle tariffs. So is this prices going up for Hermes bags in the United States, focused specifically on that market, or is this a wider pricing move?
Right, so at the beginning of the year, or last year into these results, Hermes had already said they needed to raise price about 6 to 7% to cover costs. New production sites, more labour, the quality of their product. So that was coming through. And they said at the very beginning of the year, scope and price out of this 7% growth has been around 5%. But as we go into May the 1st, they will raise prices specifically, separately in the US to cover tariff charges. And on the back of that also, we've been doing a lot of work in Bloomberg Intelligence on this to look at where EBIT cover needs to be, what price needs to come in across the different luxury companies. And actually, we heard last night, most specifically, that Brunello Cucinelli said 3 to 4% price rise, starting with their new autumn-winter collection into the US stores in July.
OK, Deborah, thank you very much. Thanks for joining us. Deborah Aitken from Bloomberg Intelligence with the latest on Hermes, came hot on the heels of LVMH, of course. Let's pivot from the luxury sector to technology. TSMC ADRs are moving higher after the world's biggest chipmaker gave a better-than-expected outlook for the second quarter. Let's get more with Matt Bloxham from Bloomberg Intelligence. So on TSMC, we got the numbers for the backward-looking stuff for the first quarter. They seem to be better than expected. And then we got the guidance for the second quarter, and that also coming in a little better than markets had anticipated. How much do we know will continue of this, though, Matt? Because it's possible to imagine a world where people front-load their purchasing if they fear tariffs are going to come.
Yeah, and that does seem to be the case both for the first quarter and for the second quarter guidance. So given that they've kept the full year revenue growth guidance unchanged, so like mid-20% year-on-year growth in US dollar terms, that implies potentially quite a big slowdown in the second half of the year. I see customers preempting the tariffs and getting as much stock in as they come. But, the company was upbeat about sustained demand for AI chips. I think, there's a lot of big hyperscalers investing a lot of money this year in capacity. So I think even if we were seeing end user demand slow down, that may not play out until 2026, where you get kind of some overcapacity issues. So I think this is going to be still quite a volatile period for a company like TSMC. Tomorrow the US administration could come out with their new tariff plan on chips and smartphones, and that could suddenly make people feel kind of quite bearish again. So I think we're seeing a lot of companies hold their guidance because they don't really know what's happening until they've got a clearer view on what the future looks like. They're just kind of holding firm. So I think people are going to be a bit cautious about the outlook. Yeah,
it almost feels on the guidance side that companies know they need to move, but they've no idea where to move to.
Exactly.
So they're just saying for now. How does this affect sentiment? I mean, we recently, just yesterday, we were talking about the Nvidia story that weighed on stocks in the States yesterday, because there are different ways that politics could play in here. There's the tariff story, but there's also security concerns between the US and China and the use of that H20 chip.
Yeah, that's right. And I guess from a TSMC perspective, there's a lot of scrutiny on their investments into US capability. They're spending $100 billion on US fab. Also, a lot of speculation about whether they're going to do a joint venture with Intel. The CEO is quite clear today that they have no plans to form a JV. They're focused on their own business, but clearly a part of that does involve that increased capability in the US. But then it's an incredibly complex ecosystem. They're a big supplier to Apple, for example. Apple obviously very reliant on China for manufacturing, so unless they see some of their partners move to the US, they could still kind of get caught up in these tariff wars indirectly. Yeah,
even if you're producing something in the US, unless all of the components come from the US, there could be tariffs somewhere along the line. Matt, thank you very much. Thanks for joining us. Matt Bloxham from Bloomberg Intelligence with the latest on themes in the tech sector. Coming up, we'll focus once again on the ECB. It's set to release its decision today with a rate cut expected. 25 basis points is what nearly all of the economists served by Bloomberg expect to see in terms of a cut from the ECB. We'll get the latest live from Frankfurt next. This is Bloomberg. Good morning and welcome to The Pulse. I'm Anna Edwards in London. In for Francine Lacqua this morning. Here are your top stories. Fed Chair Jerome Powell strikes a hawkish tone on inflation amid trade war uncertainty, dashing market hopes for a Fed put. US futures, though, rebound after positive signals from initial US-Japan trade talks. The ECB is seen cutting rates again by a quarter point amid slowing services inflation and risks from US tariffs. Plus, Hermes shares drop after sales disappoint. The luxury group warning tariffs will lead to price rises. Chipmaker TSMC gains after it maintains its full-year guidance despite growing trade worries. We begin with the ECB this half hour, which is expected to cut rates for the 7th time today after Donald Trump's tariffs upended the bloc's economic outlook. Bloomberg's Lizzie Burden joins us now from Frankfurt. So, Lizzie, these new US tariffs then, we don't know the full extent of the tariffs that in the longer term or medium term perhaps will be applied to the Eurozone. But I suppose the fact that they exist at all, in some senses, makes the ECB's decision a little easier today.
You're right, Anna. It was meant to be a nail-biter, this April meeting, but actually Donald Trump seems to have made it into a bit of a no-brainer for many on the Governing Council, because economists reckon that his tariffs are going to weigh on inflation and growth here in the euro area. And yes, you've had this 90-day pause on the 20% levies, but the talks in Washington haven't yielded much this week. And what we know is that the EU hasn't retaliated yet, so the ECB doesn't need to deal with the potential inflationary impact of that. There has been this debate about whether the fiscal boost to growth outweighs the tariff threat, but the way policymakers have been framing it is that it's long-term versus short-term. And yes, they need to be vigilant about balancing the two, but what they need to deal with in the here and now is this rapid rise in euro-dollar, which of course makes imports cheaper, exports more expensive, and therefore could potentially kneecap growth even if it's all disinflationary. And then they have to look at lower oil prices, and then they have to look at maybe China flooding Europe with cheaper goods to counter the tariffs they're facing of 145% themselves. So all roads, Anna, really point to a quarter-point cut today from the ECB, especially, as you mentioned, when you've got inflation moderating towards that 2% target, including services inflation as well.
Yes, we saw earlier on China saying it was willing to expand mutual opening up with Europe, which seemed like an interestingly timed line around access to each other's markets. We'll see what develops there. So the focus then is on the path ahead for the ECB, Lizzie.
Yet again for Christine Lagarde at this meeting, Anna. And markets are currently pricing in 2 more cuts in April and June. But we're really looking at the commentary around this decision. I would not expect them to drop the language about this being meeting by meeting and data dependent. But it'll be interesting whether they drop the language about the policy having become meaningfully less restrictive. They added those words at the last decision. If they drop them, it would really send a hawkish signal. So our economists at Bloomberg Economics reckon that they'll keep that language today. But I've been saying this all morning. There is such a lot of pressure on Christine Lagarde to really calm the markets today, given everything that we saw last week, when you haven't got a Bank of England decision this month, you haven't got a Fed decision this month, and as you've already said, the chances of Jay Powell coming to the rescue of the US economy with a Fed put seem to have been dashed last night.
Lizzie, thank you very much. Lizzie Burden in Frankfurt, of course. Let's carry on this conversation. Let's speak to Isabelle Job-Bazille, Chief Economist at Credit Agricole, with us to talk about the ECB, the decision ahead, and the global economy. Isabelle, nice to have you with us. So your expectations ahead of the ECB, will this be one of those meetings where the ECB tries to say very little about the path ahead for rates because there are so many uncertainties?
Yeah, for sure. Good morning, Anna. Obviously, no surprise today, the ECB is going to cut interest rates by 25 basis points. What will be important to hear at the press conference is the ECB reassessment of the balance of risk between growth and inflation. I think that ECB will likely share our concern regarding growth, not just because of these tariffs, but more importantly because of the high level of uncertainty that leads to wait-and-see behavior with more precautionary savings from households and a reluctance to invest for companies. And it will be also interesting to see if Mrs. Lagarde adopts a more dovish tone on inflation. These inflationary pressures are likely to intensify. There are many reasons for that. We have slower growth, we have cheaper oil prices, we have also this appreciation of the euro that makes imports cheaper as well, and obviously the risk of all these Chinese low-cost products flooding the European market. So lower growth, lower inflation, this paves the way for further rate cuts.
Yes, Isabelle, on that subject of Chinese product looking for a home, looking to be globally exported and maybe not able or too expensive to send it to the United States, so trying to get that product into Europe, how quickly are you expecting that to put downward pressure on inflation? Where will you look for signs that that is what is happening in European markets?
I think it's difficult to know exactly the timing because, as I mentioned, we have a lot of uncertainties. It is obviously a risk, but, China tried to be the adult in the room in the moment, and we want to maintain this multilateral trade system. So there are some room to negotiate with China to avoid this flooding of low-cost Chinese product.
OK, so we'll watch out for that. Given all of these downside risks for the Eurozone economy and perhaps less need to worry then about inflationary risks, Isabelle, how much cutting can the ECB do? How close to neutral are we? How far into neutral the ECB be prepared to cut?
I think that the ECB should proceed in two steps. The first step by moving towards the neutral rate, let's say 2%, because it is the middle of the estimated range of for neutral rates by the ECB, and then by remaining data dependent while looking at the smooth transmission of monetary policy. And in this respect, the last bank lending survey is interesting because it shows that the housing market is responding to the looser financing conditions. But businesses are still reluctant to take out loans, and banks are cautious to lend. And so we have this tightening of credit standards for firms, and also the negative impact of the quantitative tightening for the market financing conditions for banks. And these should be monitored and and may warrant further easing. And to go on the accommodative side of the monetary policy, maybe 2 cuts.
OK. And thinking about the United States, because the Eurozone is not an island economically, let me ask you about risks of stagflation. You say in your notes, Isabelle, that risks of stagflation in the United States have been overestimated. Why do you say that?
In fact, yes, I'm not a fan of this stagflation story. We should experience a change in relative price regarding inflation. That means that the price of manufactured goods will automatically rise due to the tariffs. But the price of services, which is the main component of the inflation index, could come under downward pressures as private demand weakens. And by the way, we have also this story around the cheaper oil price that could tame inflationary pressures. And I would say that in any case, the Fed is not supposed to respond to a temporary shock in inflation and should be more worried or more sensitive to the downside risk on growth and employment. That's why we still believe that we will experience 2 rate cuts before the end of the year.
Yes, it's interesting in the context of the recent spike up in inflation over recent years and criticism of central banks as a result of that. Interesting that we saw the Fed lean into inflation fighting, perhaps, in its narrative yesterday from Jerome Powell. Isabelle, thank you very much. Isabelle Job-Bazille, chief economist at Credit Agricole, with thoughts on the Eurozone and a little on the United States as well. We'll have coverage of that ECB decision. That's at 1:15 p.m. UK time, followed 30 minutes later, of course, by Christine Lagarde's news conference. Lizzie Burden will be there for all of that, and there'll be coverage of the rate decision, of course, here on Bloomberg Television. Now, Italy's Prime Minister is set to meet with the US President Donald Trump at the White House later today, tasked with negotiating EU tariffs. Giorgia Meloni has an ideological affinity with the president, but not everyone is convinced that will aid the discussions.
About the possibility Georgia could be better than others because she's very familiar and friendly with Trump, why not? If she will be able to achieve an agreement with Trump for the ideological reasons, okay, we are very happy. We will be very happy. But I don't believe in that, because the strategy of President Trump is a strategy, in my opinion, against globalization, and that is a problem for us.
Former Italian Prime Minister Matteo Renzi there speaking to us earlier on. Let's bring in Bloomberg's Alessandro Migliaccio in Rome with a look ahead to what Giorgia Meloni can achieve here. So, Alessandro, the Prime Minister goes to Washington with this big task to try and make some progress where Maros Sefcovic has not made very much progress on the trade front. So what's expected from today's meeting?
Well, because, as you were saying, there is some, let's put it this way, ideological affinity. There was hope that she could talk some sense into him. And, you know, in Italy, it's also known that Meloni started off as a 16-year-old in a far-right party. She has a lot of experience dealing with, let's put it this way, right-wing men. And so there was a thought that maybe she could do things that others couldn't. On the other hand, there's also controversy because, you know, within Europe, there have been complaints that we need to stay united. We need to be careful about negotiating alone with someone who is unpredictable, with someone who has shown contempt for Europe. Of course, she is in agreement with the EU. She's spoken to Ursula von der Leyen about this meeting. She's not going it alone, but there's just concern that she's going to speak to someone who is very unpredictable and doesn't really like Europe.
OK, a lot to watch then as we look at those pictures there of Giorgia Meloni arriving then in the United States. Bloomberg's Alessandra Migliaccio in Rome, thank you very much for the preview. Coming up, we'll talk technology. LinkedIn's latest AI and global economy report reveals how generative AI is reshaping growth and productivity. Sue Duke, the company's head of global public policy, joins us next. This is Bloomberg. The conversations that matter and the insights you need. This is The Pulse. I'm Anna Edwards in for Francine Lacqua in London this morning. Now, the UK's decision to leave the European Union had severe consequences for the economy, including a decline in the value of the pound and a decrease in business investment. Many Britons who voted to leave the EU now favour rejoining, if you look at some of the more recent polling on that subject. And the UK's Prime Minister has an opportunity to reset and repair some of the damaged relationship with Europe. Matt Winkler, Bloomberg's Editor-in-Chief Emeritus, has written an opinion piece about this and joins us now. Matt, very nice to see you and to get this sort of international perspective on something that happened very close to my home, of course. So give us a sense of the scale of the economic consequences that you see from Brexit. It's nearly 10 years ago now that the vote took place. But over that period, it's been difficult perhaps to untangle the impact of COVID and war in Ukraine from Brexit. So what have you discovered?
Well, you start with the day itself. You start with June 21st or 3rd, that period right after the referendum. And the pound plummeted a record 8.05% in minutes, and it was a 31-year low against the dollar. Nothing like that has ever been seen by sterling. It was a 13% depreciation in less than a week. And sterling, of course, is yet to recover. It was Britain's worst foreign exchange fiasco in the new century. if you like, it signaled John Bull's transition from biggest beneficiary among the 27 countries in the EU to a relative have-not. That's as we speak. And investment, as you said, in the UK since the referendum has either declined or showed no improvement. In addition, the country's diminishing trade with Europe is still less than its deterioration with the U.S. So it belies the leader's insistence that transatlantic commerce would boom after Brexit. And if you look at sterling these days, exchanged at $1.50 per pound. The year before the referendum, it's averaged $1.29 since June 16. That's 7% less than the financial crisis low of $1.38 in 2009, according to Bloomberg data. So any way you look at this, it's been a collapse of UK business. A reduction of 15% in trade is translated into a reduction of 4% in gross domestic product since then. That's according to Jonathan Portis, who's a professor of economics and public policy at King's College. If you look at it another way, as you said, investment in the UK is either, declined or it's flatlined.
OK. Now, if you're looking for Brexit dividends, then a lot of people pointed to that brief period where the UK was going to get a lower tariff than Europe. Since then, of course, we've seen a stay on that higher European tariff. But for a brief period, some were saying, look, this is an example of the way that the UK now has more flexibility. So with the context of President Trump now in office for a second time, what opportunity does that give Prime Minister Starmer around freedom to move, I suppose?
Well, the real obstacle all along, unfortunately, for the UK has been Vladimir Putin. And so when Starmer initiated the coalition of the willing recently, safeguarding the peace in Ukraine, he created an opportunity to transform his policies. The Trump tariffs, which, as you say, punished the UK as much as the EU, prompted investors to dump U.S. assets. That, by the way, was a force reminiscent of the 1956 Suez Crisis, which everybody in the UK, of course, knows about. Also, the U.S. regime's asymmetric sympathy for Putin. Polls show American voters support Ukraine and remain opposed to Russia. It means there is much more than enough moral and economic force for Starmer to say, you know what, times have changed since he took office in July. Unwinding Brexit when the nation of shopkeepers is simultaneously promising to boost Ukraine's defenses would be very consistent with his penchant for pragmatism. So the prime minister's situation, if you like, it recalls a very famous quote back in the 1920s from John Maynard Keynes, who said essentially, look, when the facts change, you need to change your mind. You need to change your policy.
OK, Matt, thank you very much. Matt Winkler, Bloomberg's editor-in-chief emeritus, with his thoughts on the transatlantic relationship between Britain and the United States and where Britain should go from here with its relationship with Europe. And we watch with interest as actually conversations around migration and cooperation on migration, what that can deliver between France and the UK. Now, let's pivot to technology. Generative AI could be a golden ticket for businesses and economies across the globe. LinkedIn's latest AI and global economy report reckons it could unlock $6.6 trillion in productivity across the US, UK, France, Germany and India, so across some fairly large, sizable economies. The company's vice president and head of global public policy, Sue Duke, joins us now. Sue, nice to have you with us. So where will this come from? How big a gift to the global economy and these big economies will we get from AI, according to the research that you've done?
At a time of slowing growth and slowing productivity, what we see from today's report is the enormous potential of AI to unlock innovation gains, productivity gains and growth gains. As you said, we're seeing across those 5 large markets the potential of $3.3 trillion to be unlocked. And what's really interesting is we're seeing the potential for those gains to come right across the board, across a whole range of sectors and across companies from small, medium and large. And so if we can get the conditions right, crucially, if we can put the workforce in a spot where it has the skills it needs to tap into this potential, we are in a great position to be able to channel the productivity gains from this technology into growth, into productivity and into innovation.
OK, and talk to us about the skills that businesses are going to require, Sue, to make that happen, because you talk not just about AI technical skills, but AI literacy skills. Now, is that meaning people who know what to do with the technology once they get it? So talk us through the skills that businesses need.
That's exactly right. There's 3 categories of skills that come out loud and clear from today's report and from our platform that are going to be critical to tapping into this potential and driving forward the economy with this technology. First, AI technical skills. Think of those as the skills that are needed to build this technology. AI engineering, natural language processing, those kind of skills. Second, AI literacy skills. Think of those as the skills that are needed to leverage this technology. Microsoft Copilot, ChatGPT, those kind of skills. And then the third all-important category of skills are those essential people skills. They remain absolutely at the heart of this transformation. Skills like communication, leadership, team building, they will remain critical and put alongside the technical skills and the literary skills. That is going to be the key to unlocking the productivity gains, those innovation gains that this technology clearly can bring for companies of all sizes across all sectors.
OK, and you have an interesting detail, Sue, in your research. It says that half of businesses using generative AI for 2 years have seen their revenue go up by 10% or more. Now, I wonder how that compares to the amount of money they're having to spend on AI technology. This isn't free necessarily for these businesses and requires quite a lot of investment. So do we get a sense of just, what kind of returns businesses are getting from this?
Massive returns. What we're seeing, and particularly actually for those small businesses, there is a lag in smaller businesses adopting this technology. But when they do, what we see is that they are refocusing their energy into making sure that this technology works, not just in gaining productivity for them, but in getting innovation and getting growth. They're putting those savings into product development, into accessing new markets, into getting their people in front of customers so that they can grow their business. And that's precisely why we're seeing that companies who are using and adopting this technology are seeing typically a 10% increase in growth over a 2-year period. So it speaks to the enormous potential for all of these businesses to be able to expand and grow if they have the skills they need. But that has to be at the heart of this transformation and of the adoption of this technology if we're going to be able to realize those gains.
And so you talk about different markets and where they might benefit from this technology, different geographies. So Germany, it's around manufacturing. In the UK, it's actually a lot of public services that you quote here. Is that really where the UK finds the upside?
It's one of the sectors that really sets to benefit from the application and the widespread diffusion of this technology. We see it, as you say, in health, social and education, all systems that are under increasing strain in the UK. And what this technology can do is put in the hands of workers, it frees them up to do things like personalised healthcare, bespoke tutoring, so that we are able to untap that unique human value in sectors like education and like health.
So thank you very much. Thanks for joining us. Sue Duke, Vice President and Global Public Policy Head at LinkedIn. Thank you very much for being with us. Let's have a quick recap of the markets as we bring this hour to a close, just approaching 10 a.m. here in London. And European equity markets are in retreat a little bit, echoing the selling that we saw middle of the day, towards the end of the day yesterday in the United States. So that's some of the story there. There's also an earnings story, though, to be factored in. And we see construction and materials is the weakest sector here in Europe. The likes of Heidelberg Materials, Saint-Gobain, weaker on that front. Healthcare, telecoms, travel and leisure, all of those a little weaker. Consumer products and services was an early area of weakness as we saw the negativity around Hermes and the story around luxury. But some of that has actually unwound as we've gone through the morning, and actually a better performance coming through from some of those luxury names. Now, energy stocks doing really well on the back of the Siemens energy numbers. Looking ahead then, let's have a look at the US futures picture. We are seeing some positivity there. Yesterday we saw selling on the Nasdaq and E-minis and the S&P as a result primarily of concern around technology. That Nvidia story weighed on things in the States yesterday. Today we see a different outlook, perhaps some of the headlines, progress being made around the trade conversation with Japan, perhaps that boosting sentiment just a little, and we go towards the US session with some positivity. That is us done here on The Pulse. So I'll hand you over to Bloomberg Brief. That's coming up next. This is Bloomberg.